In this video, we are going to talk about first steps in trading. So before starting this video, please like this video and subscribe to our channel for the future updates. Perhaps you use a product so frequently that family members or friends advise you to purchase stock in the manufacturer. Or maybe you have some spare cash and want to spend a little of it on the market for entertainment and, if everything goes well, profit. Here's a list of the first 5 steps in trading. Let's start. 1. Decide if this is the right strategy for you. You may think about trading stocks if your employer's 401k matching dollars are at their maximum. Participants in most 401k plans cannot buy individual stocks. Instead, they must select from a variety of mutual and index funds. However, an individual retirement account usually allows you to purchase and trade stocks. Trading inside an IRA has some advantages. Because these accounts are tax-advantaged, capital gains taxes may be postponed or entirely avoided. You have made the maximum annual contributions to both your 401k and IRA, so you are probably on track to reach your retirement objectives. By trading stocks, you can and are able to accept more risk. In this situation, opening a taxable brokerage account with an internet broker and trading within that account would be a good idea. Before you begin online trading, you should start consistently saving money for your retirement if you haven't already. One of the best strategies to create long-term wealth is to contribute as much as you can to an IRA and to your 401k plan. Find out how to start an IRA. Comparing trading individual stocks to investing in mutual or index funds entails greater risk and work. You must keep a close eye on your positions and know if and how to respond to market movements. Most retirement investors don't want to take on this kind of risk. 2. Get an education. Learn everything you can about investing and the markets before you start trading anything. Errors can be expensive. Many free educational tools are available that demonstrate how to use an online broker for trading. Think about taking an investing course on Udemy.com or Morningstar's Investing Classroom. Additionally, the majority of stockbrokers have their own educational facilities and a team of former traders or financial consultants who may offer you guidance. Paper trading. A trading simulation that certain brokers like TD Ameritrade give to their clients, is a terrific way to practice without risk or spending any money. 3. Select an online broker. Select an online broker that offers the features and assistance that meet your needs. Beginner traders should generally place a higher priority on customer service, educational materials, and account and trade minimums. Moreover, take into account the stock trading software of the online broker. New traders will need a platform that is simple to use, has how-to guides, and has a peer trading community to aid with questions. 4. Start researching stocks. You can begin investing now that your account is open. Next, what? Of course, picking stocks is the tricky part. The majority of traders begin by conducting a comprehensive investigation of a firm, reviewing available information such as earnings reports, financial filings, SEC reports, and independent research reports from qualified analysts. Your broker should supply much of this information, along with current business news and risk assessments. Pick 1 or 2 stocks to start, and invest a certain sum of money that you are willing to lose. Gains can be reinvested in the stock or other businesses, but you shouldn't put more money into the pot until you are confident in your strategy and have done your research on potential competitors. 5. Make a plan and stick to it. Investing may be emotionally taxing, especially for novices. Losing money hurts, and it's simple to become panicked and withdraw at the wrong time. Additionally, it's simple to get carried away by the thrill of a stock that appears to be on the rise. Because of this, it's crucial to prepare your investment amounts and prices as well as how low you're willing to allow a stock drop before selling. You can stay on schedule and prevent emotional reactions by using the appropriate form of trading order. To reduce risk and losses, stop-loss orders, for instance, cause a sale to occur if a stock declines to a specific price. Find out more about the various market orders. What do you think of our video? Let me know in the comment section below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.